Hello and welcome back to the show. So I'm super excited here to be joined by my guest today, Jacob Vanderslice, who is an expert in self-storage real estate investing. Jacob's been investing for quite a while. He's been involved in a few different aspects of real estate investing, and he actually has quite an extensive experience in investing in residential properties as well, having acquired over 1,000 residential properties in his background. And currently now Jacob's with the VanWest Partners, which currently manage and have a track record of over $250 million in assets in real estate. So today we're going to be talking a lot about the benefits of self-storage investing and some of the things that Jacob and his team are doing that people can apply to their own investing strategies as well. But other than that, Jacob, I want to welcome you to the show. Super excited to have you here.
Kobe, thanks for having us on. We appreciate it.
Yeah, absolutely. So before we dig into this, the strategies and some of the questions that I'm sure people have for you, would you mind just sharing a little bit about yourself and your background? You were involved in real estate before you guys got into self-storage. What was it that kind of drove you towards investing in self-storage and where you guys are at today?
Yeah, we got started investing in real estate full time way back in 2006, and I started dabbling in '05. I was in my early 20s, had a bunch of extra time on my hands. I only worked 10 days a month. I was in the fire service and bought a rental or two and fixed them up on my days off with a buddy of mine. And then I quit my job and kind of went all in on real estate. So I've been gainfully unemployed, I guess, since 2006, about 18 years now, for better or for worse. And we really cut our teeth in the residential space. We were actively investing as the financial crisis kicked off back in 2008. We all remember those days. And it was a terrifying time, but you were buying stuff at such a huge discount from where it might have traded for, 18 months ago or whatever the time frame was. So most of our deals we sourced at the trustee sales. There was a lot of auction volume. We'd show up with our bidding team with a stack of cashier's checks and our flip-flops, and we'd be figuring out our max bids at the last minute, pulling title work, making sure we're not buying a second lien position. And that was a good business for a long time. And our biggest years really were probably 13 and 14. We did a JV with institutional partner back when the big players came into the single family residential space. And those were fun years. And as we reflected on our business, though, this wasn't clear at the time, but as we kind of look backwards, we concluded our business was to a degree kind of overly transactional. We were buying and selling too often, too quickly. It was not tax attractive, right? It's all ordinary income. And it was kind of an eat what you kill strategy. You buy something, you make it better, you sell it, and you have to do it again. And we wanted to shift. This wasn't really intentional, but we wanted to shift at the time to, what if we held stuff for longer? What if we had more of a longer term strategy versus a transactional strategy? And we thought that storage was a good vehicle to do that in. And we looked at the industry for a while. We liked the fact it was historically downside protected. It performs pretty well during recessions. It performs pretty well when the economy is expanding. And we liked the durable recurring revenue streams that it offered. So we did our first storage deal in 2015, and at the time, it wasn't really a fundamental pivot from one strategy to another. It was more just kind of let's try a deal out and see what happens. And then we did a second one and a third, and over time we evolved to being primarily a self-storage owner operator. So we've sold some deals lately. We bought some more, but we currently have 37 properties around the country, just over 19,000 units and about 3 million square feet. And generally what we do some development, but most of our projects are value add existing facilities. We'll identify properties that have sort of either unsophisticated or kind of sleepy ownership groups, and their operating expenses are above market, their rents are below market. And we add value through capital improvements and rebranding, but mainly by more effectively operating the property.
Yeah, that sounds awesome. So you started out in residential as far as more on the fix and flip side, it sounds like, and then decided that you wanted to transition more into a less transactional, more buy and hold strategy, and decided on self storage. So I guess like for most investors, uh, the path that they would take is if they're doing a lot of fix and flips, they will transition into buying and holding single family rental property. So what was it that went into that decision? Why didn't you decide to go that direction and just jump into storage immediately from that?
Well, we've gotten a little bit less stupid every year, and I would assume by next year we'll be a little less stupid than we are right now. And the lack of foresight that we had and discipline that we had was we should have held on to more properties on the residential side. We should have sold, three and held on to one, right? Sold three, hold on to one. And we held on to some, but the percentage of single family rentals that we own is a very, very small piece of the overall total transactions we've done. And as we considered holding some of these for rentals, the challenge at the time was just scalability, it was financing, it was leaving a lot of equity kind of stuck in a deal when you could monetize that. And mainly the reason was cash flow. Even though the market was materially different, back in 15 than it was today, it was still getting tight, and values had gone up so much and so quickly that your cost basis was becoming so high that your return from a cash flow perspective was diminishing if you were converting these things to rentals. So at the time, it just didn't really make sense, and we concluded storage was a good vehicle. One of my partners built a property with his family way back in the day in California. They still own. So that was the breadth of our storage experience. Hey, one of my partners built this when he was in high school with his parents, and that was our experience. But we liked it, and we liked the flexibility. We liked the revenue management. We liked the fact it's all month-to-month leases. And let's face it, fair housing laws have gotten much more tenant friendly across the country in the last couple of years, and that was definitely a concern too. It's just owners' rights, right? The ability to actually get possession of a property from a tenant that wasn't performing and wasn't paying was kind of becoming more difficult, and we thought storage was a good answer to that.
So basically, what I'm hearing is essentially there's not a lot of stress involved as far as tenant management goes when it comes to self storage versus investing in residential properties, right? Where you have to think about
Well,
and put in strategies and systems that have to deal with a lot of these more or less intangible aspects of tenant management, right? If you get a bad tenant, they're just being difficult. It could lead to a lot of lost money and of course a lot of stress and hard on your mental health as well, which is
yeah. Well, what you said is true, but it's only true within a narrow vein, and that the eviction process is a little more simple in self-storage than it is in residential, kind of depending on the market. But I will say that the grass is always greener. There's a common misconception that, oh, storage, no tenants, no problems, or no toilets, right? No problems, whatever the case might be, whatever the saying is. And that couldn't be further from the truth. Storage is very operationally intensive. We have hundreds of customers moving in, moving out every month. We have theft issues. We have homeless issues with folks sleeping in our units sometimes when they're not supposed to. Natural disasters. We have U-Hauls running into our $30,000 gate systems or into our buildings. We have delinquency issues. So it is operationally intensive, but there is a little bit of a shining light in that it's a bit easier to remedy somebody who's not performing in your storage unit versus in your apartment building in, say, New York, which is an extreme example, but it's a little bit different there.
right. Yeah, the tenant laws definitely in New York are quite friendly to the tenants. So yeah, so I wanted to ask you a little bit more on the storage side as far as some of the benefits, right? So as far as what you guys are doing in acquiring self storage properties, you mentioned a lot of what you guys do focuses on improving it, right? Focuses on value add to the self storage unit itself. So when it comes to value add to a storage facility, what does that look like? Is most people understand, value adding to like a rundown property for residential use, but what about a storage unit, right? You're just putting your stuff in there. What is it that you guys are doing? What are you looking for? And how do you add value to a storage facility?
Well, let's talk about the downside, first of all, to the asset class, kind of the main risk profile to investing in self-storage, whether you're buying an existing facility or building one new, beyond the standard real estate risks like rents, cap rates, interest rates. The main risk is supply. Self-storage is very local supply sensitive. So we track supply ratios in a very narrow trade radius. And if somebody builds a giant facility next to yours at some point in the future, that's going to really reduce your occupancy and your in-place revenue because of the supply and demand curve, right? A bunch of new supply hits the market, rents go down, occupancies go down, and it's kind of a fight to the bottom. So that's really the main risk profile of storage. As far as the reasons we like it and how we create value, a couple of the main reasons we like it are, first of all the leases are month to month. So our customer likes that because they can come and go as they please without a long-term rent commitment. But most of our customers end up staying a lot longer than they anticipate. And one of our portfolios in our third fund, for example, we haven't owned the deals this long, or the asset base for more than 2 years, depending on the deal. But with the prior ownership, we studied how long has our average customer been in there for. And we found that over 50% of our customers had been storing for 3 years. So even though it's a month-to-month lease, the customer base is pretty sticky. And that's one of the reasons we like it. And the month-to-month lease works on the ownership side because you can respond real time to supply and demand changes, both at the unit level and at the sub-market level. So if you have a unit type that's really full, for example, you can raise rates with a 1 month notice and probably not get any move outs and drive some more revenue. And if you have a unit type that maybe is lighter on occupancy, you can drop rates below market on that unit type, fill those up, and then start kind of pushing rates over time. So the revenue management levers are very dynamic, and you can, to a degree, experiment real time. And if the experiment doesn't work, you can course correct and probably not have too much mud on your face. But not unlike other real estate asset classes, the value creation in self-storage is growing net operating income. And I'm sure some of us who are listening right now maybe aren't clear on what that is, but net operating income, or NOI, is purely gross revenue minus expenses. And it's a universal metric that's used to value real estate. And how do you use that to value real estate? Well, you value it based on a multiple of that income stream, or a capitalization rate, or a cap rate. So whether you're doing a multifamily deal, industrial, or self-storage, among many things, your main singular focus, and there's a lot that goes into this, is growing NOI, right? Increasing rents and controlling operating expenses. And that's where value is created. Well, how do we do that in the storage business? We do it a couple different ways. One is kind of obvious. We take an empty unit and we put a customer in there that's paying rent. So we grow our unit occupancy over time. And that's in the form of advertising, effective revenue management. And the second way we do it are something called existing customer rent increases, or ECRIs, to get kind of nerdy on you. If none of us walk away from anything from this today, you can learn a little self-storage jargon, ECRI, existing customer rent increase. And that's purely, you got a guy in there paying $100. You tell him, hey, dude, next month you're paying 110. And he looks around the submarket and he figures out, gosh, I'm going to pay the same rate or more if I move. I don't want to go call my buddies up on the weekend and rent a truck. I'll pay 110 and I'll move out eventually. So rent increases is a big value creation component. And the second, behind occupancy growth and ECRIs, is the implementation of ancillary income streams. These are things like tenant insurance, late fees, U-Haul truck rentals, one-time administrative fees when a customer moves in. And $10 a month in ancillary income may not seem like a lot, but if you amortize that across thousands of units, you annualize that, you put a cap rate on it, you've created a lot of value just with a little $10, change to your revenue. So those are the main ways we create value on the operations side. Immediately after acquisition, depending on the project type, we'll rebrand it and we'll install new gate systems, new camera systems, roll-up doors, roofing systems, seal coating the asphalt. So we are improving these projects from a CapEx perspective, but most of the value creation comes from that singular focus and just growing NOI in the three ways I described.
Right. So adding more value to a storage facility just really comes down to, on the investor side of things, being able to increase the amount of revenue that you guys are able to generate and keep, right? So increasing rents, adding more ancillary revenue streams as well. That's kind of the perspective you want to look at it. Now, you mentioned earlier the fact that a lot of times when another storage facility comes in, right? Maybe they're developing it from the ground up, right next to an existing one. A lot of times they can take away a lot of your existing customers, right? So what are some of the things that you've seen people do or you guys are doing to keep your customers within your within your source facility instead of having to move away? Is there, different things that you guys are doing to add value to the people who are actually renting out these storage units to store their things in?
Yeah, well, customer retention starts even before we buy the deal. And what we're doing leading up to an acquisition is subjectively and objectively, we're determining the risk of new supply. So, what are the chances that somebody can build or will build near us anytime soon? And we're looking at that risk through the lens of zoning. So, are there a lot of parcels in the submarket that allow for storage use? Or is it a municipality that is averse to self-storage and it's really tough to get projects entitled? We're also looking at building permits, concept reviews. So there's different levels of data depending on the city, but some cities will show you if someone's come into the planner's office for what we call at least a pre-flight conversation, like a concept review. So we'll look and see what's planned out, what's in the pipeline, how likely are those projects are to get built. For example, is one deal got a building permit a year ago. What's happened with it? Well, it's still empty ground and there's no construction loan on it, and there's been no movement on earthwork or site work or anything. Well, that one may get built, it may not get built, and we're going to think about it, but it's probably not coming online imminently. Or have they broken ground, right? They're vertical, they've got their steel up. So that's what we're doing kind of on the front end. But after acquisition, once you buy it, you can't truly defend against public storage building a bomber, a mile away from you 3 years from now. But the way we defend against that to retain our customers is real time, almost real time, multiple times a day. We're analyzing our competitor rates and we're responding real time to our rates to make sure that we're still kind of towards the bottom of the market. And sometimes we'll be at the top of the market, but there's no supply available and occupancies are in the high 90s. We can push those a little more aggressively than in a market that might be getting oversupplied. So really, it's a commodity. Self-storage is truly there's no brand loyalty. It's just kind of price and location, convenience, and to a degree quality. So multiple times a day, we're looking at what our asking rents are relative to what competitor rates are, and we're responding kind of real time. And if a customer tells us why they're moving out, and they tell us, oh, the reason is my rate's too low, or I got a better deal down the street, we'll try to cut a deal with them. Hey, what about 50% off for next month, and we'll waive your tenant insurance or whatever the case might be. We'll do little things to try to retain them, but in most cases, over 80% of cases, when somebody moves out, they're moving out because they're done with their self-storage need for the time being. They're rarely moving their stuff to another location. It's rarely because we increase their rate by $10. Chances are, if they're moving out, they were going to move out anyway. But on the other 20%, we do everything we can to kind of keep them happy with competitive rates and a good customer experience.
Right. So it's pretty straightforward as far as what you're looking for in terms of, your competitors, right? It's, what are they charging as far as rates go and how are you guys comparing? Now, as far as, you mentioned that most of the time customers move out just because they don't need the self-storage unit anymore. Do you think that's gonna be mostly because they're not necessarily wanting to go through the stress and the additional costs of just moving from one storage facility to another just to store their things because there's costs and there's obviously, moving stress and, you know, operational for them in order to move from one storage facility just to another one just to, decrease their rents for like 20 or $30 a month.
Yeah, and it's very, I want to say it's very rare, but it's unusual for someone to move to another storage facility when they still need storage. Typically, the reasons for their move for the fact they're moving are their life has changed. They're building a new house and it's done now, right? So they're going to move into it. They're going to clean out their storage unit, or they're relocating markets, or maybe their basement finish is done and they're going to move their stuff back into their basement. They no longer need extra space for their stuff. So most of the time it's life changes on the reasons they move out, but it's also the same reasons they move in, right? The fundamental demand driver for self-storage as an industry really is life changes, getting a job, getting married, getting divorced, upsizing or downsizing your home, moving to a new location, moving from Denver to Houston. Those life changes are the demand drivers. So they need storage when their life changes, and they don't need storage after their life changes back to wherever they're going.
Right. So I think that's actually a pretty interesting thing about storage, right? Because people are not necessarily looking to move from one property to another. It's just when they need it, they move in. When they don't need it anymore, they move out. So it becomes
Yeah,
a
it's not like multifamily where you make some more money, you get a better job, and you move from that 1980s one bedroom to the new construction two bedroom in a better part of town. You're not moving in storage from your, junky non-climate controlled 10 by 10 to your elevator access climate controlled 10 by 15. You're not upgrading the quality of your storage unit because of your income. But you are in residential. So it kind of definitely works differently there.
right. And that's a good comparison, right? Because now that's, I would think, a benefit of the self-storage asset class versus residential, because now you don't have that, that attrition of existing customers that you have for those reasons. Now, kind of wanted to talk with you about next is the acquisition side of things. So acquiring self-storage units, obviously, that's going to be a big part of, obviously investing in them, right? If there's no self-storage facilities for you guys to actually invest in, then there's no investment to keep, right? So what are you guys doing on the acquisition side? And you mentioned earlier you're looking more for like delinquent owners who are not really doing a great job with the properties that they have. Are you guys mostly going direct to source? Are you going between a broker? What does that look like on the acquisition side for you guys in self-storage?
Yeah, not unlike other asset classes, deal flow and storage is challenging, and it has been challenging for quite a while now. I wonder how many podcasts I've said deal flow is challenging on, like going back to 2022, and it remains challenging. And the reason for that is there remains a pretty wide bid ask spread between what a seller will sell for and what a buyer is willing to pay. And sellers that don't have to sell are kind of sitting this out for a while. I don't need to take a haircut on my valuation theory. I've got long-term debt. I don't have to sell. I'm going to kind of sit this out. If I don't get the price I want, I don't need to sell. So transaction volume's gone way down, and that's obviously not unique to self-storage. It's unique to single family. It's all over the place. Single family, multifamily, industrial, even office, which is really easy to trash talk, right? Even not a lot of office properties are trading relative to what might have happened historically. So deal flow is tough. Um, we find our deals, over 70% of them we've sourced off market. And off market is not a term I use lately, because we all know off market can mean different things to different people. And in our view, off market is the market has never publicly seen this deal available for sale. And we mostly get off market deals through broker relationships. And brokers are they're humans just like the rest of us, right? I don't use it, but I've had my license for a little while. I use it occasionally to do personal deals and save on transaction costs. But brokers just want the easiest path to getting paid their commission, right? Whether the deal is selling for 10 million or 9 million, it's not a huge delta to them. They want surety of close, they want execution. So it's very important to us to perform when we go under contract on a deal. Unless it's a really good reason, we'll almost never retrade. Like some buyers will take the approach, if you don't ask for it, you don't get it, right? You hit them at the last minute for 200 grand off the price because of whatever. And you might get your seller to agree to it, but they're going to be upset. And your broker is going to be upset because they have an upset seller. And they're probably not going to bring you the next deal because they don't want their next client to get upset when somebody retrades for 200 grand. So we really try to perform and pay the price that we agreed to unless we find something material. And that broker will keep bringing us deals. So often they'll get a seller, they'll give us pricing guidance. Hey, this group needs 10 million net, and they'll walk. Can you guys do it? And we'll get back to them quickly. We'll underwrite it immediately. And the next day we'll tell them yes or no. And we either go under LOI or we move on to the next deal. On the other 30% of the deals that we buy, um, they're marketed, but they're poorly marketed. Somebody might have a cousin who is a Remax agent, and they put it on the residential MLS, but none of the storage buyers see it because they're not looking at the MLS for a storage deal. If it's a fully marketed deal by a national brokerage outfit that the entire country sees, we can almost never compete. There is cheaper money out there than ours. very low return thresholds, and we'll miss deals sometimes by millions of dollars, like 25 to 50%. It'll trade for 15 million and we could pay 8 or whatever the number is. So mostly through relationships, but the deals that meet our risk adjusted returns are pretty tough to find right now. We're recording this um, in mid to late May, and we closed on our first acquisition in 2024 about 2 weeks ago. It was a deal in Jacksonville, Florida. And that wasn't from a lack of effort, wasn't from a lack of capital. It was just the first deal that we found that met our risk adjusted return requirements. So it's tough to find deals right now, for sure.
Right. Yeah. And making sure that you have those good broker relationships, right? Like you mentioned, not, completely lowballing the seller at the last minute or doing something where you're not going through with the deal that actually helps you out a lot because these brokers, they can actually bring you more deals. And because they know that you are a buyer, essentially, that is going to stick to your word and you will perform when the time comes. As well. And you also mentioned a little bit earlier on that you guys do a few developments from the ground up as well. Is that correct?
We do. Development is a different animal, right? It's a different risk profile. And I think that the main risk in development, aside from you're building a new building, you could have cost overruns and change orders, but the main risk is you're underwriting theoretical rents. And they're not necessarily theoretical because you know what's happening in the submarket. You know what a similar unit type is renting for today and what it rented for 6 months ago. But when you buy an existing facility, even if it's undermanaged or mismanaged, you've got trailing financial data that you can kind of hang your hat on and know that, okay, if we really screw up our value creation strategy on this, at least we know what the previous owner did for rents on a 10 by 10 or a 10 by 20. When you're building new, you don't have that data point. So with that comes increased risk. But obviously, with increased risk, you ideally are going to have an increased reward with a better return from a multiple and an IRR perspective. So we do build. We built a $15 million project here north of Denver that we delivered in December of last year. And we currently have a $25 million project under construction, which is a big number for storage. Storage is generally the deal sizes are a bit smaller. I know 25 million is a lot to all of us here sitting here, me included. But I mean, you hear about apartment buildings that are being built for 200 million, right? A massive apartment community or whatever the number is. The storage, the deals just aren't as big from a dollar perspective. And those deals are they're difficult to get entitled. You've got the rent risk factor. Obviously, when you open the store, you can hit your revenue stream targets. So development can be done, but it's more challenging today than it has been ever before because number one, deals are tough to get entitled, right? Municipalities generally a little more averse than they were a couple of years ago to self-storage development. You've got elevated hard costs, right? You've got this boom and this increase in labor and materials coming out of the COVID years. And typically those don't go down. They just go up and they kind of stay there. And then they go up again later. It's rare that you see a big price decline in labor and materials. So it costs more to build them than it ever cost before. And obviously your interest rate on a construction loan today is materially higher than it was 2 years ago. So it's much more difficult to make them pencil. So development's interesting and it's attractive and we'll do it here and there. But it's not our primary line of business.
Right. Yeah. So pretty much that's a part of your business, but it's not necessarily what you're looking for, even when there is lower supply of self-storage units you can acquire. That's not something that you're looking to do because of kind of the risks and the operations involved in development, right? So it's not
Yeah,
something that
we'll underwrite development deals and we'll look at them, but it's very rare they're penciling right now for all the factors I mentioned a moment ago.
right. Yeah, so we talked a little bit about your operation side on acquiring and running self-storage facilities as an investor. So I want to dig a little bit deeper into kind of what it looks like for what you guys are doing with your investors, right? So what does that look like? Are you guys just raising money, as a fund or as a syndication? What does that look like on that side if somebody were to say, want to invest in self-storage passively, not necessarily be that active investor just yet?
Yeah, we've got kind of three different food groups on how we structure our deals. The first two are single asset syndications and funds. And typically Syndication and a fund kind of look and feel very similar. It's got a preferred return, it's got a waterfall, there's a split, later with the investors and the sponsor. But the big difference between syndications and funds is in a syndication, you're kind of buying a singular, so to speak, stock. It's like you're buying an Amazon stock, right? So inherently, you've got less diversification than you would if you were buying a mutual fund. So you can look at a fund vehicle, whether it's storage, multifamily, is a little more diversified. You're buying into a mutual fund of self-storage versus one self-storage stock. But some people don't like funds because maybe they want to be, for whatever reason, in North Carolina, but they don't want to be in Florida. And if the fund buys a deal in Florida, they don't have a lot of control or say over, where the fund might buy that deal. So the third food group that we have within the method that we capitalize our deals are also programmatic joint ventures. So we'll do JVs with small institutions, family offices. Where it's one project, they'll put up 90% of the equity. We'll put up 10%. We'll promote it, and we'll do that deal kind of on a standalone basis. So those are really the three ways that we do our deals. But beyond trying to hit a good return target from a multiple and an IRR perspective, I said we're very focused on NOI growth earlier. And with NOI growth comes cash flow. Cash flow, durable recurring revenue, is our definition of wealth. It's not net worth. It's not an IRR. It's not a fairy tale pro forma based on assumptions that aren't going to happen for 5 years. What's real to us and what's real to our investor partners, I think, is cash flow. So every deal we do is very cash flow focused. Now, it might be a different path to that cash flow. Obviously, if you're building a new project from the ground up, you're not going to have cash flow for years, but cash flow is still the end target. So yeah, those are the three different types of vehicles that we do, and we're very cash flow focused.
Yeah, so you guys are focused on cash flow, which is a really good thing because a lot of times investors, when they're investing in real estate and different types of, I guess investment vehicles or ways of investing, whether it's a syndication or fund, they're really looking to, a lot of what's being, I guess, marketed to them is the appreciation, right? And the appreciation is great, but you can't spend appreciation, right, from month to month. So, it's really,
And you
I think
can't
it's really
spend
important.
IRR either, right? Yeah, IRR, or internal rate of return, it's an annualized return metric that's used to describe the investment target of any given private real estate deal, or any deal for that matter. And IRR is an elusive metric. What's real though, and what's quantifiable, is cash flow, right? You put $100,000 into a deal and you get 8,000 a year in distributions. That's a lot more meaningful than a model that says, hey, you bought it for 10 million, you're going to sell it for 15 million in 5 years. The cash flow is a lot more visceral and quantifiable, I think.
Right. And is that how you guys are marketing to potential investors as well? It's just pretty straightforward. This is what it's gonna look like, right? This is how much you're putting in. This is the cash flow that it looks like for you getting out. Because a lot of investors, right, they're not, you know, involved in the industry. That's all they can comprehend. So you don't want to overcomplicate things.
Yeah, well, even though we are cash flow focused in this environment, very few deals that we're seeing or that we bought lately produce immediate cash flow. And that's for a couple different reasons. One reason is our leverage going in is much lower. So a couple years ago, we were using 70% leverage, and now more often it's like 50% leverage. So the use of your equity is a little bit less efficient because you're putting, so to speak, a larger down payment into the project. So inherently, your returns on your equity are going to diminish because it's a bigger piece of the capital stack. Secondly, asset values are still fairly inflated. I don't want to say they're inflated, but they remain high. Even though you've got rising interest rates, you're not paying that much less for a given storage deal than you were a couple of years ago. And arguably, you might be paying more. And the second reason for that diminished cash flow is pretty obvious, but it's interest rates, right? A couple of years ago, or 2.5 years ago, we were financing on a 10-year fixed at, say, 4%. Today, that same loan is at 7 or 7.5%. And all things being equal, pay the same price, you perform the same way in the deal, your cash flow on a 4% loan is going to be a lot higher than it is on 7.5%. So cash flow is definitely much harder to find today than it was a few years ago.
Right. Yeah. But it's great that you guys are focusing on that because again, for a lot of other investors, they're using a lot of industry jargon, if you will. And
Yep.
for those investors that are marketing to, they don't quite understand it unless they're also involved in real estate as well. So That's pretty great that you guys are doing that. But Jacob, man, I appreciate you being here today. You shared a ton of value with us as far as understanding not just the benefits of investing in self-storage facilities, but also the very real risks and downsides of this as well, right? I think you gave us a very realistic expectation and view of what it looks like to invest in self-storage facilities. So for people that want to connect with you and learn more about what you guys are doing and really follow your journey as you move forward in investing and scaling up your operations, what are some of the best places for people to get more information about you guys, what you guys are doing as a company, and just overall get educated on this process?
Yeah, we always love to talk shop about real estate. People can reach us. They can email me, Jacob at vanwestpartners.com. They can go to our website, vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Awesome. We will make sure to leave the links to those in the description and show notes down below. But other than that, Jacob, thank you again for being on the show. And do you have any last pieces of advice, any last tips for our listeners here before I let you go here?
Well, I would say if you've been reading the books and listening to podcasts and going to classes and going to seminars and RIAs and whatnot, and you haven't taken action yet, the best way to learn about real estate investing is to take a risk and do a deal. Whether that's buying your first fix and flip or rental or passively investing in your first syndication and fund, the way you learn is by doing. You're not going to learn this stuff enough by just being on the sidelines and listening. So yeah, my advice is take a risk and do a deal.
Awesome. Love it, man. Great advice. And I thank you again for being here. And thank you for tuning in. And we'll see you in the next show. Take
Thanks,
care.
Kobe.